Usually when we talk about a medical diagnosis, there's this expectation of absolute precision. It feels almost like engineering, right? You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, well, there it is. That's the problem, and here's the exact solution.
Right, it's binary, which is incredibly comforting. I mean, human beings naturally gravitate toward things that can just be made visible and neatly categorized.
Yeah, exactly. But then you step into the world of corporate finance, specifically into the boardroom where the future of a multi-billion-dollar company is being decided, and suddenly you realize that a comforting x-ray machine is completely shattered.
Oh, completely.
We're looking at a diagnostic landscape of risk, return, and firm value that is, quite honestly, terrifyingly murky.
It is the absolute definition of diagnostic muddy waters. You are no longer looking at a single broken bone. You're trying to predict the weather patterns of human behavior, macroeconomic shifts, and theoretical math, all at the exact same time. And that chaotic intersection is exactly what we are navigating today.
So, welcome to this extensive deep dive. Today, we are speaking directly to you, the MBA student, the aspiring financial manager, the future CFO, who is staring down the absolute behemoth that is the capital structure decision.
It's a big one.
Our mission today is to take this seemingly abstract, deeply academic concept and break it down so thoroughly that you don't just, regurgitate it for a final exam. We want you to actually master it so you can deploy it as a weapon in your future boardroom.
Because the underlying reality is that every single business on Earth, no matter how large, how complex, or how disruptive, relies on two fundamental financial decisions. They are the twin engines of capitalism, basically.
Right.
The first is the investment decision. That's the glamorous part. That's deciding how to spend money on assets that will yield the highest possible return over time. I mean, it's deciding to buy a competitor, build a state-of-the-art manufacturing plant in a new country, or launch a revolutionary software product.
It's designing the blueprint of a 100-story skyscraper. It's the vision.
Exactly. But the second decision, the engine that has to fire simultaneously, is the financing decision. How on earth do you actually raise the capital to undertake those brilliant investment projects? So today is exclusively about that second decision. We are looking at the foundational architecture of how a company funds its own existence.
And here is the aha promise for you as you listen today. The ultimate goal of the financial manager isn't just to, get their hands on a pile of cash.
No, not at all.
Honestly, any moderately functional company can find an institution willing to give them cash if they are desperate enough and willing to pay exorbitant rates. The true elusive goal is finding what academics and practitioners call the optimum capital structure.
It is the holy grail of corporate finance. It's not about just filling the bank account. It's about finding the exact, fragile, perfect mix of borrowed money, which we call debt, and owner's funds, which we call equity.
And when you find that perfect mix,
you achieve two phenomenal things simultaneously. First, you minimize the company's overall cost of capital. And second, as a direct mathematical result of lowering those costs, you maximize the market value of the company's shares. When shareholder wealth is maximized while keeping risk at a tolerable minimum, you have successfully engineered the optimum capital structure.
Okay, but here's where it gets really interesting, though. Right out of the gate, that definition brings up a massive, glaring contradiction. And this is the central mystery I want you to hold on to for this entire deep dive.
Let's hear it.
As we will soon establish, borrowing money is almost always vastly cheaper than using equity, largely because of, incredible tax loopholes. So, if debt is the cheaper ingredient, why doesn't every single company just fund itself entirely with debt?
Right.
I mean, why not just borrow 100% of the money you need, push your cost of capital to the absolute floor, and send your share price to the moon?
It's the most intuitive question a student can ask. And the answer is a profound lesson in the nuances of risk, leverage, and the foundational theories of modern finance. But to solve that mystery, we have to start at the very beginning. Before we can start mixing the perfect financial cocktail, we need to completely understand the raw ingredients sitting in the corporate pantry.
Okay, let's unpack this. We are specifically talking about long-term finance here.
Yeah.
We need to separate this from working capital, right? This isn't about floating next month's payroll or paying a supplier for a shipment of raw materials.
Right. Long-term sources of finance are structurally different. They are generally defined as capital needed for a period extending well beyond a single fiscal year, often stretching into decades. The reasons a company reaches for this kind of heavy-duty financing are transformational. You are looking to finance massive, irreversible expansion projects.
Like imagine a massive retail chain deciding to acquire a massive swath of prime commercial real estate to build 50 new flagship stores.
Or a pharmaceutical giant that needs to fund 10 years of clinical trials for a new experimental drug. Or perhaps it's an aggressive M&A strategy, mergers and acquisitions. You want to execute a hostile takeover of your biggest rival.
Wow, yeah.
These initiatives are incredibly complex, they involve staggering amounts of capital, and it is exceedingly rare that a firm will fund them using just one single monolithic source of cash.
They use a menu, they blend their options, and the two main sections of that menu, the yin and yang of corporate finance, are equity financing and debt financing. So let's do a deep dive into equity first, because it's the bedrock.
Equity is the foundational source of funding for any business enterprise. At its absolute core, equity financing means you are exchanging a permanent portion of the ownership of your business in return for a financial investment.
You're giving away a slice of the pie, and once it's gone, it's very hard to get back.
The permanence is the key feature. The investor is not loaning you money. They are buying into the DNA of the company. They get an ownership stake, which legally entitles them to a share of the company's profits, presumably forever. Now, for the MBA student listening, there is a vital, non-negotiable distinction you must internalize.
Okay, what is it?
The difference between common equity and preferred equity. They exist in totally different risk stratospheres.
Because all owners are definitely not created equal in the eyes of the law.
Far from it. Common equity is your standard baseline stock. It's the oldest method of corporate ownership. When you hold common equity, you have standard distribution rights, meaning if the board declares a dividend, you get a piece. And crucially, you have voting privileges.
You get a proxy ballot. You get to vote on the board of directors. You get a say in major corporate actions like selling the company.
Exactly. The simplest corporate structures, like your average mom-and-pop shop that incorporates, usually just have a single, unified class of common equity.
But when things get complicated, when major institutional investors get involved, you see the introduction of preference equity or preferred stock.
Preferred equity is a fascinating instrument because it acts almost like a hybrid between stock and a bond. It's a distinct, separate class of ownership. It is explicitly called preferred because it carries powerful preferential features that elevate it above common equity. And the absolute most important feature, the one venture capitalists insist upon, is liquidation preference.
Okay, let's paint a picture of why that matters. Imagine the worst-case scenario. The company fails, it goes bankrupt, the assets are being auctioned off for pennies on the dollar, and there's only a tiny pool of cash left over.
In that apocalyptic scenario, the preferred equity holders get to stand at the very front of the line.
Yeah.
They have a legally binding right to get their initial investment back, and sometimes a multiple of that investment, before the common equity holders are allowed to see a single dime.
And the common holders usually include the founders and the employees, right?
Yep.
So it's a massive safety net. The founders might lose everything, but the preferred investors might walk away whole.
Furthermore, preferred equity routinely carries defined minimum yields. This often takes the form of a guaranteed cumulative dividend.
Wait, what does cumulative mean in this context?
Let's say it's a 6% preferred dividend. If the company hits a rough patch and the board decides they need to conserve cash, they might skip that dividend payment for a year or two. But because it's cumulative, those missed payments stack up as a liability.
Oh, wow.
Yeah, the company is legally forbidden from paying out any dividends to the common shareholders until every single missed payment to the preferred shareholders is paid in full.
So if equity is all about ownership, sharing the upside, and voting power, the other side of the menu is entirely different. Let's talk about debt. In the sophisticated finance world, you'll often hear debt referred to simply as leverage.
Right. Debt financing is fundamentally transactional. It involves funds borrowed from a lender, be it a massive commercial bank, a specialized financial institution, or the public bond markets. And unlike equity, debt comes with rigid, uncompromising conditions.
And the two most critical are a fixed mandatory rate of interest and a hard predetermined maturity date.
Exactly. The principal amount you borrowed must be returned in full by that specific date, no matter what economic condition the company is in.
And companies are pulling this debt from a variety of deep pockets, right?
The avenues are vast. A company can go to a syndicate of commercial banks for a massive term loan. They can issue corporate bonds directly to the public markets, effectively turning thousands of individual investors into their lenders. In various global regions, there are also specialized development banks institutions specifically designed to fund massive infrastructure or industrial projects that standard banks might find too risky.
When a CFO sits down to negotiate this debt, the conversation immediately turns to collateral. This is the divide between secured and unsecured debt.
It alters the entire risk profile of the loan. Secured debt means the company has physically pledged an asset as collateral. If an airline wants to borrow $1 billion to buy a fleet of new jets, they will use the jets themselves as the collateral.
Makes sense.
If the airline defaults and misses their interest payments, the lender has the legal right to seize those jets, sell them, and recoup their money. Because the lender's risk is so significantly reduced by having that hard asset as backup, secured debt comes with a much lower interest rate.
Unsecured debt, on the other hand, is basically a loan backed by nothing but the company's reputation and future cash flows.
Right. If the company defaults on unsecured debt, the lender just becomes another general creditor in bankruptcy court, hoping to get a fraction of their money back. To compensate for that massive vulnerability, lenders charge significantly higher interest rates for unsecured debt.
Let's distill this into a real-world analogy to anchor these concepts for you. Equity is like bringing on a co-founder for a new business venture. They share the absolute unlimited upside. If the business becomes a billion-dollar unicorn, they are billionaires too.
Yeah.
They get a share of the profits forever. But the friction is that they also get a vote. They get to sit in the room and argue with you about the logo, the hiring strategy, and the product roadmap. Debt, conversely, is like renting a commercial building.
I like that.
You have to pay the landlord the rent, the interest every single month, flawlessly, whether your business is booming or you haven't had a customer in weeks. Eventually, the lease is up and you have to settle the principal. But the beautiful part, the landlord doesn't get to walk into your office and tell you how to run your business.
Yeah.
They have zero voting rights.
The landlord just wants their check on the first of the month. It's a perfect visualization. But the decision facing the CFO isn't merely a philosophical choice about who they want telling them what to do. The critical pivot here, and the foundation of corporate finance, is that choosing between debt and equity mathematically alters the underlying risk and return profile of the entire organization.
Which brings us to the physics of finance. We need to talk about leverage. This is often referred to as a double-edged sword, and I want to explore exactly why it can make you a hero or bankrupt you overnight.
The word itself is revealing. The root is lever. It's about using a mechanical tool to multiply force. In the physical world, a lever allows you to lift a boulder you couldn't move with your bare hands. In the business world, leverage refers to the strategic use of fixed costs to multiply returns for the shareholders.
Right.
But to truly master this, we have to split it into two entirely distinct phenomena: operating leverage and financial leverage.
Let's tackle operating leverage first. This has nothing to do with banks or loans. This is strictly about the operational cost structure of the business itself.
Every business on the planet has operating costs, and they fall into two distinct buckets: fixed costs and variable costs. Fixed costs are the expenses that do not change, regardless of how much you sell. Rent for the factory, salaries for the executive team, insurance, depreciation on heavy machinery.
And variable costs.
Variable costs, however, move in direct lockstep with your sales volume. The cost of raw materials, the shipping fees, the hourly wages of the assembly line workers. Operating leverage is a measure of the degree to which a firm utilizes fixed costs in its daily operations.
And mathematically, it measures how a change in top-line sales volume impacts the company's earnings before interest and taxes, which we call EBIT, essentially the operating profit.
Operating leverage is born whenever a firm can increase its revenues without suffering a proportionate increase in its operating expenses. Think of the multiplier effect. If you have massive fixed costs, it takes a lot of sales just to break even.
Yeah, that's the scary part.
But once you cross that break-even threshold, those fixed costs are already paid for. From that moment on, a disproportionately massive percentage of every single new sale drops straight down to the bottom line as pure operating profit. Therefore, the degree of operating leverage is a direct proxy for business risk. High fixed costs mean high operating leverage, which means a highly volatile profit stream.
I want to make this incredibly concrete for the listener, so let's walk through a hypothetical scenario. Let's invent two competing companies operating in the same industry, but with radically different philosophies. Let's call them Sky High Airlines and Cloud Consulting.
A brilliant contrast. Let's set the baseline for both.
We'll start with Sky High Airlines. This is a heavy industry legacy business model. They lease a massive fleet of jets, they maintain huge maintenance hangars, they pay fixed salaries to thousands of unionized pilots and ground crew. Their fixed costs are astronomical.
Oh, yeah.
Let's say out of $10 million in total costs, $8 million are purely fixed. Only $2 million are variable things like the peanuts they hand out and the jet fuel for extra flights.
So their ratio of fixed to total cost is incredibly skewed. They possess very high operating leverage.
Exactly. Now let's look at cloud consulting. They are an agile gig economy consulting firm. They don't own a single office. Everyone works remotely. They don't pay salaries. They only pay their contractors an hourly rate when a client actually books a project.
Right.
Their fixed costs are basically just server hosting and software subscriptions. Out of $10 million in total costs, maybe $1 million is fixed and $9 million are variable contractor payouts.
They have intensely low operating leverage. Now imagine both companies are currently generating enough revenue to squeeze out a modest operating profit, an EBIT of, say, $2 million.
Now let's inject a massive economic boom. Sales volume across the entire industry spikes by 50%.
Watch what happens to the heavy industry firm, Sky High Airlines. Their revenue goes up by 50%. But those massive $8 million fixed costs, the jet leases, the hangars, they don't budge. They stay exactly at $8 million. Only their tiny variable costs increase.
Right.
Because the vast majority of their expenses were already locked in and covered by the initial revenue, almost all of that new 50% revenue surge falls directly to the profit line. Their operating profit doesn't just increase by 50%, it might explode by 300% or 400%.
The magnifying glass of operating leverage at work. It's a miracle during a boom. Now let's look at cloud consulting, the agile firm.
Their revenue also increases by 50%, but because their business model relies on paying hourly contractors, their variable costs soar right alongside their revenue. For every new dollar they bring in, they immediately have to pay out 90 cents to the contractor who does the work. Their profits will increase, yes, but only proportionately. A 50% increase in sales might just yield a 50% increase in operating profit.
So what does this all mean for the financial manager? Sky High Airlines saw a 400% profit surge, while cloud consulting saw a modest 50% bump. Sky High looks like an absolute genius.
They look like geniuses until the economic winds change. That is the essence of business risk. Operating leverage is a multiplier in both directions. If a recession hits, or a global pandemic grounds flights and sales drop by 50%, Sky High Airlines is in existential peril.
Oh, absolutely.
Their revenue plummets, but that $8 million fixed cost bill for the jets still comes due every single month. Their profits won't just drop by 50%, they will crater by 400%, plunging the company into massive bleeding losses instantly.
Meanwhile, cloud consulting just stops hiring contractors. Their variable costs vanish along with their revenue. They weather the storm.
That is the trade-off. We codify this with a specific formula. The degree of operating leverage, or DOL, equals the percentage change in EBIT divided by the percentage change in sales. It is the mathematical proof that building a company with high fixed costs is highly rewarding in a boom, but highly lethal in a bust.
That perfectly captures the operational side of the business. Now let's move to the second half of the equation. Financial leverage. In classic Wall Street parlance, this is often called trading on equity.
It's an old-school phrase, but it's incredibly descriptive. Trading on equity derives from the reality that it is the owner's initial equity, the foundational net worth of the company that is being used as the basis, the collateral, to raise debt. You are standing on the foundation of your equity to reach up and borrow other people's money.
So financial leverage is the strategic use of fixed charge sources of funds like bank loans and corporate bonds alongside the owner's common equity to fund the company's investments.
And the conceptual why behind it is simple arbitrage, though it's complex to execute flawlessly. The entire intent of financial leverage is to earn a higher rate of return on the borrowed funds than the interest rate you have to pay for those funds. If a company goes to a syndicate of banks and borrows $100 million at an 8% interest rate, and they invest that massive pile of cash into expanding their manufacturing capabilities, which yields a 12% return,
then the math is beautiful. They take 8% of those returns, hand it back to the bank to satisfy the interest payment, and that remaining 4% spread belongs entirely free and clear to the equity shareholders.
Precisely. That 4% constitutes the pure profit derived from financial leverage. The company used other people's money to generate wealth for the owners. The rate of return on the owner's equity is mathematically levered above the base rate of return on the company's total assets.
Let's summarize the math here without getting bogged down in tedious arithmetic. Imagine a company needs $1 million to launch a new product line. They expect this product line to generate a massive operating profit. If they fund that entire $1 million by issuing stock in all-equity plan, they have zero debt.
Right.
They take all the profit, pay their taxes, and then they have to divide whatever is left over among a massive pool of shareholders. The earnings per share, the EPS, might be decent, but it's diluted across all those people.
Now imagine the alternative, the debt equity plan. They only raise $500,000 from shareholders, and they borrow the other $500,000 from the bank at a reasonable interest rate. The product line generates the exact same massive operating profit. Yes, they have to siphon off a piece of that profit to pay the bank's interest. But the crucial trick is that the remaining profit is now divided among a vastly smaller pool of shareholders. They only issued half as many shares.
So even though the total net income of the company is slightly lower because of the interest payments, the earnings per share, the EPS that dictates the stock price, actually skyrockets. The return on equity is magnified.
That is the intoxicating magic of financial leverage. By substituting debt for equity, the firm concentrates the rewards into a smaller pool of owners.
Here's where it gets really interesting, though. I have to push back on this utopian vision. If the debt equity plan definitively increases the earnings per share and the stock price goes up and the board is throwing a party, why does every seasoned finance professor warn that financial leverage is a double-edged sword?
Because of the arrogant assumption hidden inside the projection, we assumed the company's new product line would be a massive success. We assumed they would generate enough operating profit to easily cover the interest. Financial leverage has two primary undeniable advantages: enhanced earnings per share, which we just proved, and a wildly favorable tax treatment because interest payments are deducted before corporate taxes are calculated.
Oh, right, the tax shield.
The tax shield is a massive incentive, but the danger lies in the downside risk.
What if the world changes?
What if the new product line is a total flop? What if a competitor beats them to market or a supply chain crisis destroys their margins? Suddenly, their operating profit evaporates. Under the all-equity plan, the shareholders might not get a dividend that year, the stock price might slump, but the company survives. They owe nothing to anyone. Under the debt equity plan, however, the bank doesn't care about the supply chain crisis. The bank demands their fixed interest payment.
And if the company doesn't have the operating profit to pay it?
They default. They are suddenly thrust into insolvency and facing immediate bankruptcy risk. The leverage magnifies the losses exactly as fiercely and with much more devastating legal consequences as it magnifies the gains. We measure this volatility using the degree of financial leverage, or DFL. It tells a CFO exactly how wild the swings in their net income will be based on tiny fluctuations in their operating profit. The higher the leverage, the closer they are dancing to the edge of the cliff.
And because the academic world of finance loves to build comprehensive models, we can combine these two distinct concepts: the operating leverage that multiplies the business risk and the financial leverage that multiplies the financial risk. We call this the degree of combined leverage, or DCL.
It is the ultimate diagnostic metric. Operating leverage dictates how a change in sales volume affects operating profit. Financial leverage dictates how a change in operating profit affects bottom-line earnings per share. If you want to understand the total holistic risk profile of the entire firm, you combine them.
A high DCL is the financial equivalent of driving a race car with no seatbelts.
It means you have engineered a highly volatile, highly risky corporate structure. You have massive fixed operating costs, like our airline, meaning you need an enormous amount of sales just to break even operationally. And on top of that, you have massive fixed debt payments, meaning you need a huge operating profit just to keep the banks from foreclosing. If top-line sales dip even slightly in a scenario like that, the compounding, cascading effect will wipe out shareholder value entirely. A low DCL, conversely, means a much more stable, resilient, but perhaps less aggressive setup.
This understanding gives us the perfect transition. We now understand the menu of debt and equity. We grasp the mathematical, magnifying physics of both operating and financial leverage. But knowing the mechanics is just step one. Put yourself in the expensive leather chair of the chief financial officer. The board is demanding growth. The markets are volatile. How does a CFO actually decide on the optimal capital structure in the real messy world?
You certainly don't just guess, and you absolutely cannot rely on a single, isolated math formula. The textbook lays out 9 highly practical determinants of capital structure. These are the 9 specific competing pressures that a financial manager must constantly weigh against each other.
Let's flesh out these 9 determinants by grouping them into strategic themes, so the MBA student listening can easily internalize them. Let's start with the classic, agonizing boardroom tug-of-war: cost versus control.
Determinant number 1 is the fundamental cost of capital. The entire process of raising funds involves a cost. Generally speaking, debt is inherently cheaper than equity. This is primarily because interest is tax-deductible, creating that massive tax shield, and because debt holders legally accept lower returns since their risk is mitigated by collateral and bankruptcy precedents. So if a CFO is looking purely at a spreadsheet and trying to minimize costs, they will lean heavily toward debt.
But determinant number 2, management control, pulls them violently in the other direction.
This is deeply psychological and strategic. Imagine you are the visionary founder of a disruptive tech company. You've bled for this company for a decade. If you issue more common equity to raise funds, you are selling off your voting power. You are diluting your ownership.
And if you dilute too much, activist investors or a hostile board can literally fire you from the company you built.
Exactly. If your primary overriding intention is to retain ironclad effective control in a few trusted hands, you will heavily favor issuing debt. The bank takes your money, but they don't get a seat at the boardroom table.
You want the silent landlord, not the opinionated co-founder. Okay, the next strategic grouping: legal and time factors.
Determinant 3 is legal requirements. A company doesn't operate in a theoretical vacuum. It operates within a strict regulatory framework. Depending on your jurisdiction, whether you are dealing with the SEC in the United States or SEBI guidelines and the Companies Act in India, the legal hurdles to issue public shares can be agonizingly high.
Yeah, the paperwork alone.
The compliance costs, the mandatory disclosures, the sheer time it takes to draft a prospectus can paralyze a company. Sometimes the legal and regulatory friction of a public equity offering is so burdensome that a company opts for a private, syndicated bank loan simply because it's faster and requires less public disclosure.
And determinant 4 is the duration of finance. This is about matching the tool to the timeline.
Precisely. Are you funding a short-term crisis or a long-term vision? Short-term needs almost always necessitate borrowings. If you have a 6-month inventory shortfall due to a supply chain glitch, you aren't going to go through the massive hassle of issuing permanent voting common stock to cover it. You get a short-term line of credit. But long-term needs, like a 20-year infrastructure build, strongly favor long-term equity or issuing 30-year corporate bonds. Mismatching the duration using short-term debt to fund long-term assets is a classic recipe for a liquidity crisis.
That makes perfect intuitive sense. Let's look at the third grouping: purpose and characteristics.
Determinant 5 asks a blunt question. What is the purpose of financing? Is the expenditure productive or non-productive?
Non-productive sounds like a terrible business strategy. What does that mean?
In financial literature, it's often called a betterment expenditure. It means spending massive amounts of capital on something that is necessary, but doesn't immediately generate the hard cash flow required to pay back a loan. Upgrading the aesthetics of your corporate headquarters, for instance, or spending 5 years on foundational R&D that might not yield a patent.
Ah, I see.
For non-productive betterment, it's vastly safer to use retained profits or patient equity capital. But if the funds are for a highly productive purpose, say buying an automated manufacturing rig that will definitively reduce production costs by 20% the day you plug it in, that suits debt perfectly. The machine essentially generates the specific cash flow needed to pay its own interest.
And determinant 6 is company characteristics. This is where reality bites for a lot of entrepreneurs.
Size, age, and credit standing dictate your reality. If you are a scrappy, brand new AI startup operating out of a garage, you literally cannot walk into a major commercial bank and ask for a $50 million unsecured loan. You have no credit history, no predictable cash flows, and no hard assets to offer as collateral.
Right.
You don't get to choose your capital structure. You must rely entirely on equity. You have to find venture capitalists who are willing to embrace massive risk in exchange for massive potential upside. But contrast that with a massive 100-year-old blue-chip utility company. They have pristine credit, billions in assets, and predictable monopolies. They have the luxury of choosing whatever mix of debt and equity they desire.
The final grouping is the external world, the macro and micro environment.
Determinant 7 is economic conditions. The macroeconomy dictates investor psychology. If the broader economy is spiraling into a recession or depression, investors are terrified. They become incredibly risk-averse. In a severe depression, a rational company should actually prefer equity capital because it involves less existential risk for the firm. There are no mandatory fixed interest payments that could force them into bankruptcy if their sales suddenly plummet.
But wait, during a depression, isn't it impossible to raise equity?
That's the bitter irony. It is nearly impossible to raise equity because terrified investors refuse to buy stocks.
So they might be forced into expensive, restrictive debt covenants just to survive, but what about during a roaring boom?
In an economic boom, the capital markets are flushed with liquidity. Animal spirits are high. A company can essentially choose either path. But it becomes incredibly easy and tempting to raise equity in a boom because investors are feeling greedy, stock prices are inflated, and the public is eager to take risks on the promise of future growth.
Determinant 8 brings it back to the micro level, the stability of earnings.
This is the ultimate governor on the leverage engine. If a company's sales are wildly fluctuating, perhaps they're a luxury travel company entirely dependent on a booming stock market, or an agriculture firm at the mercy of the weather, they simply cannot afford the risk of high fixed debt payments. A bad year will bankrupt them.
Makes total sense.
But if you are that utility company we mentioned, selling water and electricity, your earnings are stunningly constant year after year, regardless of the economy. You can afford to take on a very high, aggressive level of debt because you know with near mathematical certainty exactly how much cash is coming in next month.
And the final determinant, number 9, the invisible hand that warps the entire system. Tax policy.
We've touched on it, but its impact cannot be overstated. Corporate taxation policy heavily, sometimes disproportionately, dictates capital structure. In almost every major tax code globally, the return paid on borrowed capital interest is classified as an allowable business expense. It is deducted from your profits before the government takes its cut. It acts as a massive government-subsidized shield for your income.
But equity doesn't get that.
Right. Dividends paid to equity shareholders do not get this treatment. They are paid out of the profit that is left over after the government has already taken its taxes. This structural legal advantage is the strongest magnetic pull toward debt in modern corporate finance.
So synthesizing all of this, if you are the CFO stepping into a board meeting, you are essentially playing a multi-dimensional strategy game. If you have incredibly stable, predictable earnings, you desperately want to keep voting control away from activist hedge funds, and you want to exploit a massive tax shield to protect your profits, you stack up on debt. You play the leverage game aggressively.
Exactly.
But if you are a risky, unproven biotech startup operating in a volatile industry in the middle of a global recession, you have to find patient equity because taking on the rigid demands of fixed debt payments would be an absolute death sentence.
That is the practical, boots-on-the-ground reality of designing the architecture of capital.
Which brings us to the intellectual climax of our deep dive. We are transitioning from the practical, boardroom determinants to the foundational financial theories that underpin them. We are entering the academic battleground.
This is where the brightest minds in economics have warred for decades over one ultimate defining question. Do these financing decisions actually change the total fundamental value of the firm? If a CEO waves a magic wand and swaps 20% of the company's equity for debt, does the actual underlying value of the corporation suddenly increase?
This is the legendary relevance versus irrelevance debate. Let's start with the relevance theories, which proudly and definitively state, yes, capital structure does matter. Changing your mix changes your overall value.
The primary pillar of the relevance theory is the net income approach, or the NI approach, introduced by the academic David Durand. The core rule here is a simple, intuitive equation, V equals S plus B. The total value of the firm is simply the sum of the market value of its equity, which is S, plus the market value of its debt, which is B.
And how does manipulating that mix actually change the total value?
Durand based the NI approach on a few very specific, rigid assumptions. First, he assumed a world with no corporate taxes. Second, he asserted that the cost of debt is practically always less than the cost of equity. And third, and this is the vital controversial crux of the theory, he assumed that the use of more debt does not change the risk perception of the equity investors.
Meaning, the shareholders don't suddenly demand higher returns out of fear just because the company took out a massive, risky bank loan. They remain perfectly content.
Exactly. And because of those specific assumptions, the logic flows smoothly. Debt is the definitively cheaper source of finance. Therefore, the more of this cheap debt you substitute for expensive equity in your capital structure, the more you drive down your overall weighted average cost of capital, your WACC.
Right, the WACC goes down.
And in the fundamental mathematics of finance, if you lower a firm's overall cost of capital, the present value of its future cash flows increases. Therefore, the overall value of the firm must mathematically increase.
To summarize Duran's view, leverage creates value. More debt equals a cheaper cost of capital, which equals a more valuable company.
That is the essence of the net income approach.
Okay, I have to step in and challenge David Durand here. That third assumption you highlighted, that investor risk perception remains completely static. That defies human psychology. A rational equity investor who is paying attention is definitely going to demand higher potential returns if a company suddenly takes on massive, crippling amounts of debt. The perceived threat of bankruptcy has to alter their behavior. They will demand a higher yield to compensate for their anxiety.
You are echoing the exact devastating criticism leveled by the wider academic community. That incredibly valid point gave rise to the traditional view. The traditional view acts as a pragmatic compromise between extreme theories. It acknowledges that debt is indeed cheaper, but it also acknowledges the messy reality of human behavior and risk perception. It outlines a firm's capital structure journey through 3 distinct evolving stages.
If you are an MBA student trying to visualize this, picture a U-shaped curve on a graph. This curve represents the company's weighted average cost of capital.
Stage 1 is the phase of increasing value. In the beginning, when a totally unlevered firm takes on a prudent, moderate amount of debt, the equity investors aren't overly panicked. The cost of equity stays relatively stable. It might rise a tiny fraction, but not nearly fast enough to offset the massive mathematical advantage of incorporating that cheap debt. Therefore, the overall WACC smoothly decreases, and the total value of the firm increases.
That's the left side of the U-curve sloping downward into cheaper capital.
Then you reach stage 2, the optimum value. This is the absolute precise bottom of the U-curve. The firm has reached a specific, delicate degree of leverage where the mathematical advantage of adding more cheap debt is now exactly, perfectly offset by the rising anxiety and therefore the rising cost of the equity investors.
So they balance each other out perfectly right there.
The investors are starting to get genuinely nervous. At this specific sweet spot, the WACC is at its absolute minimum, and the firm value is at its absolute theoretical maximum.
And if the CEO gets greedy and pushes past that sweet spot,
you enter stage 3, declining value. This is the right side of the U-curve, sloping violently upward. The company has taken on entirely too much debt. The financial risk is flashing red. The equity investors now perceive a highly realistic probability of imminent bankruptcy, so they demand astronomically high capitalization rates to compensate for their terror.
wow.
In fact, even the debt holders, the banks, might start demanding higher interest rates because they are worried about default. The WACC skyrockets, the cost of funding becomes crippling, and the overall market value of the firm plummets.
So the traditional view is the ultimate boardroom compromise, it says. Yes, capital structure absolutely matters, but only up to a very specific tipping point. Your job as CFO is to find the exact bottom of that U-curve and hold the line.
Exactly. It felt like the definitive answer. But then, the academic world of finance was thrown into absolute chaotic upheaval by the introduction of the irrelevance theories. These theories argue, with intense mathematical rigor, that a firm's capital structure does not affect its underlying value at all. Firm value is completely fundamentally independent of how it chooses to finance itself.
And incredibly, the first major shot fired in the irrelevance debate was also proposed by David Durand. He created the net operating income approach, or NOI, essentially arguing against his own previous theory.
It's a fascinating intellectual pivot. The NOI approach states that the overall cost of capital, the WACC, is a permanent constant. It is a flat horizontal line. It never changes, regardless of whether you have 10% debt or 90% debt.
Wait, how does he possibly justify that after proving debt is cheaper?
He argues that the broader market capitalizes the value of the firm as a whole entity, based entirely on its underlying operating income and the inherent risk of its business model. The arbitrary split between debt and equity is merely an illusion of packaging. He asserts that any minor mathematical benefit a firm derives from infusing cheaper debt is instantly, automatically, and exactly negated by a simultaneous increase in the required rate of return demanded by the equity shareholders. The risk perception adjusts instantaneously.
So, if I manage to shave off 2% of my costs by using cheaper bank debt, My equity holders instantly look at the balance sheet, realize the bankruptcy risk has marginally increased, and they immediately demand a 2% higher yield on their stock.
Precisely. The benefit is completely and flawlessly wiped out in real time. Therefore, under the NOI approach, there is no magic sweet spot. There is no optimum capital structure. Every conceivable mix of debt and equity is exactly as good and exactly as valuable as any other.
Which sets the stage for the absolute heavyweight champions of modern financial theory, Modigliani and Miller. The famous approach. If you take one thing away from an MBA finance course, it's usually this.
Franco Modigliani and Merton Miller devised this framework in the late 1950s, and it won them a Nobel Prize. Their hypothesis is the absolute bedrock of modern corporate finance teaching, even though, to prove their point, they had to rely on some famously utopian, almost science fiction-level assumptions about how markets work.
Let's lay out those assumptions clearly, because understanding the artificial vacuum they created is crucial to understanding the theory itself.
They assumed a universe of perfectly frictionless capital markets. They assumed absolutely zero corporate income taxes, which eliminates the debt tax shield entirely. They assumed no transaction costs or broker fees. They assumed that individual retail investors can borrow and lend money at the exact same pristine interest rates as massive multinational corporations. And finally, they assumed all firms exist in easily identifiable homogeneous risk classes.
In that perfect, frictionless, theoretical vacuum, they proposed Proposition I.
Proposition I states, with mathematical certainty, that the value of a levered firm, a firm with debt, is exactly, precisely equal to the value of an identical unlevered firm, a firm with no debt.
Let's try to visualize this without using the tired old pizza analogy.
Right.
Imagine two identical gold mines sitting right next to each other. They have the exact same veins of gold, the exact same equipment, and they pull the exact same amount of gold out of the ground every single year. The cash flows are identical.
A perfect analogy.
Mine A is owned outright by a group of investors who paid cash. Mine B was purchased using a massive mortgage from the bank. Modigliani and Miller are saying that the total underlying value of those two mining operations is exactly the same because the gold coming out of the ground, the operating cash flow, is what actually dictates the value, not the mortgage paperwork sitting in the office.
That is the conceptual heart of Proposition I. The financing structure is irrelevant to the asset's wealth-generating capacity. But Modigliani and Miller didn't just state this as a philosophy, they proved it mathematically through a mechanism called the arbitrage process.
This is where students traditionally get lost in the weeds. I won't spend real time on this.
Yeah.
How does the market actively force these two identical companies to have the exact same value? Walk us through the mechanics of this arbitrage.
Let's use a detailed hypothetical. Imagine two identical companies in that perfect market. Firm L, which is levered with debt, and Firm U, which is completely unlevered, purely equity. Because they are identical businesses, their operating profits, their EBITs are exactly the same. Let's say $1 million a year.
But Firm L, the levered one, has $5 million in debt sitting on its balance sheet at a 10% interest rate. Firm U has zero debt.
Because Firm L has that debt, the equity investors perceive higher financial risk. So the market assigns Firm L a higher equity capitalization rate, essentially the hurdle rate or yield the investors demand to hold the stock. Let's say the market demands a 16% return on Firm L's equity. Firm U, being perfectly safe with no debt, only requires a 12.5% return from its equity holders.
Let's follow the cash to calculate the total market value of both firms. Firm L makes $1 million in operating profit. They have to pay 10% interest on their $5 million in debt. That's $500,000 in interest. That leaves exactly $500,000 of profit available for the equity shareholders.
To find the market value of that equity, we divide that $500,000 in profit by the 16% required return. That gives Firm L an equity market value of $3.1 to $5 million. Add the $5 million of debt back in, and the total market value of Firm L is $8.125 million.
Now let's value Firm U. They make the same $1 million in operating profit. They have zero debt, so zero interest. The entire $1 million goes to the equity holders. We divide that $1 million by their safer 12.5% required return, and the total market value of Firm U is exactly $8 million.
Aha! We have a discrepancy. The levered firm, Firm L, is currently valued by the market at $8.125 million, while the identical unlevered firm, Firm U, is only valued at $8 million. This seems to prove the traditional view. It implies leverage magically created $125,000 of extra value.
But Modigliani and Miller said, Not so fast. This imbalance is an illusion, and it cannot possibly last in a perfect market because of ruthless, rational investors. Let's call our rational investor Ms. Alpha.
Enter Mrs. Alpha. She is a sharp institutional investor who currently owns 10% of the shares of the overpriced levered firm, Firm L. Her 10% equity stake is currently worth $312,500, and her share of the annual earnings is 10% of the $500,000 available to equity, which gives her an annual income of $50,000.
Mrs. Alpha looks at the market and sees that Firm L is technically overvalued compared to the identical Firm U. She sees an arbitrage opportunity, a temporary glitch in the matrix that allows her to lock in the exact same income while taking cash off the table. What is her play?
Her first move is to liquidate. She sells her entire 10% holding in the overpriced Firm L. She puts $312,500 in cash into her pocket. Now, she wants to move her money into the cheaper Firm U, but she doesn't want to lose the aggressive financial returns that the leverage in Firm L was giving her. So she decides to manufacture that leverage herself. She creates homemade leverage.
Wait, how does an individual investor do that?
Remember the utopian assumption. assumes individuals can borrow at the exact same corporate rate. So Mrs. Alpha goes to her prime broker and borrows money on her personal account equivalent to 10% of Firm L's debt. Firm L had $5 million in debt, so she personally borrows $500,000 at that same 10% interest rate.
So let's look at her war chest. She has the $312,500 from selling her shares, plus the $500,000 she just borrowed. She has $812,500 in pure cash, ready to deploy.
She takes $800,000 of that cash and buys exactly 10% of the unlevered Firm U. Remember, Firm U's total equity value was $8 million.
Okay, the trap is set. Let's track her new returns to see if the arbitrage worked. Firm U generates its $1 million in profit. Mrs. Alpha now owns 10%, so she receives a massive dividend check for $100,000.
But she has liabilities now. She has to pay the interest on her personal margin loan. She borrowed $500,000 at 10%. That means she owes the broker $50,000 in interest.
She takes her $100,000 dividend, pays the $50,000 interest bill, and she is left with a net income of exactly $50,000.
It is the exact same net income she was getting when she owned the levered Firm L. But look closely at her initial personal outlay. To get that $50K return in Firm L, her personal wealth was tied up to the tune of $312,500. By executing this homemade leverage arbitrage, she achieved the exact same return, but she only used $300,000 of her own original capital, heavily supplemented by borrowed money.
That's brilliant.
She literally has $12,500 of her original cash left over in her pocket, and she hasn't sacrificed a single cent of annual income. She exploited the mispricing.
And here is the macroeconomic impact. As thousands of hedge funds and algorithms spot this same mispricing and execute the exact same arbitrage simultaneously, aggressively selling Firm L shares and aggressively buying Firm U shares, the fundamental laws of supply and demand take over. The massive selling pressure will drive the price of Firm L down. The massive buying pressure will drive the price of Firm U up. This will continue relentlessly until the total values of the two firms become completely flawlessly identical.
That mechanism is the arbitrage process. It mathematically proves that in a perfect market, a corporate manager cannot create value simply by shuffling paper and changing the capital structure. If the company tries to artificially create leverage, investors will just replicate or unwind that leverage on their own personal accounts to seek the best deal. The value is driven purely by the asset's cash flow, not the debt ratio.
It's a breathtakingly elegant theory, but of course the limitations are glaring the second you step out of the classroom.
The limitations of proposition I immediately break the perfect market illusion. In reality, investors find personal margin loans highly risky and legally inconvenient compared to the limited liability of corporate debt. The risk perception of a corporate default versus a personal devastating bankruptcy is vastly different. Real-world transaction costs and broker fees would eat up Miss Alpha's arbitrage profits. And most critically, the fatal flaw. Corporate taxes do exist in the real world.
Which leads us out of the 1950s perfect market and into how this actually dictates boardroom strategy today. When you reintroduce the messy reality of taxes into these clean academic models, you arrive at the trade-off theory.
The trade-off theory is the prevailing pragmatic model. It fully acknowledges the truth we discussed during the 9 determinants. Interest payments provide a massive, mathematically undeniable tax shield.
Because you deduct the interest before the government taxes the profit, the government is essentially subsidizing your debt.
Therefore, the actual effective cost of debt is significantly lower than the nominal interest rate the bank charges you. The trade-off theory forcefully advocates that a rational CFO should absolutely capitalize on this by loading up the company with debt, aggressively exploiting that tax shield to increase firm value, but only until they hit a specific, terrifying breaking point.
And that breaking point is the intersection of the tax shield and the Grim Reaper. It's when the mathematical cost of potential financial distress, the legal fees, the lost supplier confidence, the sheer probability of bankruptcy finally exceeds the marginal cash value of the tax benefits.
Exactly. It's a high-wire balancing act. You are constantly trading off the tangible tax savings against the rising existential threat of bankruptcy. A great financial manager pushes the debt load as high as they possibly safely can, maximizing the tax shield without tipping the company over the edge into insolvency.
Okay, the math makes sense. But human beings run companies, not algorithms. And human beings are terrified of looking weak. This brings us to my absolute favorite framework, the pecking order theory. This theory tosses out the rigorous math of calculating optimal mixes and tax shields entirely. Instead, it looks deeply at human psychology and the concept of asymmetric information.
The pecking order theory is beautifully cynical. It states that, in reality, corporate firms don't hunt for some magical, mathematically optimal debt-to-equity ratio. Instead, the CFO and the CEO simply follow a strict, deeply ingrained psychological hierarchy, a pecking order of financing options based entirely on the path of least resistance and least public exposure.
And that rigid order is internal funds first, debt second, and new equity as a painful, absolute last resort. Why do they follow this?
It comes down to asymmetric information. The managers inside the corporate fortress know vastly more about the true, unvarnished state of the company than any outside analyst or investor ever could. They know if a key product is secretly failing in trials. They know if a massive new contract is about to be signed. They possess proprietary information, and managers desperately want to keep that information secret.
Let's view this through the lens of a CEO. If you fund your new expansion using internal funds, just taking the retained earnings out of the corporate treasury, you don't have to explain yourself to anyone. You don't have to sit in front of a skeptical bank loan committee and open your books. You don't have to publish a prospectus that your competitors will instantly read to steal your strategy.
Exactly. Internal funds offer total secrecy and total autonomy. It is always the preferred choice. But if the internal treasury runs dry and you still need capital, you move to option 2, debt. Going to a syndicate of banks is slightly painful. They will demand to see some internal projections, they will impose covenants, but crucially, they don't get a voting seat on the board, and they don't share in the massive upside if your secret project is a wildly successful unicorn. You contain the exposure.
But issuing new equity, going back to the public stock market to issue millions of new shares, the pecking order theory says the market views this as a massive, screaming red flag.
Because of that asymmetric information, the public market is deeply suspicious. The psychological game theory kicks in. The market thinks, wait, if this CEO's new secret project is truly as amazing and profitable as they claim, why on earth are they willing to dilute their own ownership and share those massive future profits with us?
Yeah, that makes you wonder.
The only logical reason they would sell us new stock is if they secretly know the stock is currently overvalued. They're cashing out at the top. Therefore, the mere announcement of a new equity offering is interpreted as a negative signal, and the stock price almost universally drops on the news.
CFOs are terrified of triggering that stock drop. It angers the board and threatens their jobs.
Because of this profound fear of signaling weakness, managers avoid issuing new equity at almost all costs. The academic studies show they will literally pass up a moderately profitable, positive net present value project. They will refuse to grow the company if the only available way to fund it is by suffering the humiliation and stock drop of issuing new common stock.
That is stunning. They would rather stunt the company's growth than navigate the psychological minefield of diluting the current shareholders. That is the pecking order theory in action psychology overriding pure math.
It is the reality of the boardroom.
Okay, we have covered an immense, challenging amount of ground today. For the MBA student or future CFO listening, here is your strategic recap. We started by dissecting the menu. The permanent, voting, high-risk nature of common equity versus the fixed cost, non-voting, rigid nature of debt and preference shares.
We explored the physics of business risk through the magnifying glass of leverage. Operating leverage magnifies your core business risk through the burden of high fixed costs, while financial leverage uses other people's money to magnify your earnings per share and return on equity at the cost of introducing severe bankruptcy risk.
We looked at the 9 practical determinants, the real-world pressures. From the visceral necessity of a founder maintaining management control to the harsh realities of the macroeconomic environment and the ever-present overwhelming gravitational pull of the corporate tax shield.
And we charted the volatile evolution of academic financial theory, from David Duran's early net income approach, where more debt magically creates more value, to his own reversal in the net operating income approach. We broke down the beautiful, frictionless logic of Modigliani and Miller's perfect market arbitrage, and finally landed back in the messy real world with the trade-off theory's high-wire balancing act and the pecking order theory's stark psychological realities of asymmetric information.
So we've discussed at length how a financial manager utilizes these complex theories to painstakingly build an optimal capital structure. They balance the lucrative tax shield against the terrifying specter of bankruptcy risk. They calculate their precise WACC. They try to find the exact bottom of that theoretical U-curve. But I want to leave you with a final, unaddressed question to ponder as you prepare to take these concepts out of the classroom and into your career.
It's a critical question about the fragility of theory when it collides with reality. We design these incredibly precise, optimal structures, assuming a somewhat stable, predictable economic horizon. We assume the math will hold. But what happens to that carefully mathematically designed capital structure when a massive, completely unpredictable macroeconomic shock occurs?
What happens when a sudden global crisis hits? International supply chains freeze instantly, inflation skyrockets, and central banks are forced to triple interest rates almost overnight.
The foundation of your U-curve vanishes. That cheap, variable rate debt you relied upon suddenly becomes ruinously expensive upon refinancing. The stable operating income you needed to service that debt evaporates. The perfect capital structure you built on Tuesday becomes a death trap by Friday.
How agile can a massive corporation's capital structure truly be when the foundational macroeconomic math it was built upon changes in a matter of days? Can you realistically unlever a multi-billion-dollar firm fast enough to save it from a liquidity crisis?
That is the true ultimate test of a financial manager. It's one thing to design and build the blueprint for the skyscraper when the weather is clear. It is an entirely different skill set to retrofit the steel framework while the earthquake is actively destroying the city.
Keep that tension in mind. Take these models, respect their mathematical elegance, but critically understand their limits in the face of human behavior and global chaos. Bring that level of strategic, critical thinking into your next case study or your next board meeting. You ready?